Imagine waking up one morning, checking your investments, and discovering they no longer exist. Not because the stock market crashed, not because of a war, not because of a recession, but because an entire company, one worth tens of billions of dollars, was built on a lie. Now here's the strange part. Almost everyone knows about Enron. Many remember Bernie Madoff. Some know about Theranos. But one of the biggest corporate frauds in modern history barely gets talked about today. It fooled Wall Street. It fooled banks. It fooled regulators. It fooled some of the smartest investors on earth. Thousands of employees lost everything. Millions of ordinary investors watched their savings disappear. And for years, nobody realized the numbers were fake. This isn't just a story about greed. It's a masterclass in how appearances create trust, how complexity hides deception, and why some of the world's biggest companies can collapse almost overnight. Because sometimes the most dangerous fraud is the one that looks the most successful. This is the story of Wirecard, the greatest corporate fraud you've probably never heard of. Level 1, the perfect success story. In the early 2000s, Germany wanted its own Silicon Valley. America had Apple, Microsoft, Google, Amazon. Germany wanted a global tech champion. Then came Wirecard. At first glance, everything looked impressive. The company processed digital payments. Every time someone bought something online, Wirecard claimed to move the money behind the scenes. It sounded boring, but incredibly profitable. As e-commerce exploded, so did Wirecard. Revenue kept rising. Profits kept growing. Its stock price skyrocketed. Investors couldn't get enough. Eventually, Wirecard became so valuable, it replaced Commerzbank in Germany's prestigious DAX index. That meant it officially became one of Germany's biggest companies. Its CEO, Markus Braun, looked exactly how people imagined a tech genius. Black turtleneck, quiet personality, big vision. He promised a future where cash would disappear, payments would become invisible. Wirecard would power that future. Investors believed every word. Banks lined up to lend billions. Analysts issued glowing reports. Financial magazines celebrated Wirecard as Germany's answer to Silicon Valley. Success looked inevitable. But behind the glossy presentations, something wasn't adding up. Level 2, the numbers that nobody questioned. Here's the fascinating thing about financial fraud. It rarely starts with billions. It starts with something small. A tiny exaggeration, a delayed expense, an optimistic forecast, then another, until eventually. The entire company depends on keeping the illusion alive. Wirecard's reports looked almost magical year after year. Revenue increased. Profit margins stayed remarkably high. Cash reserves kept growing. The company claimed huge profits from business in Asia, especially through mysterious third-party partners. These partners supposedly handled payment processing where Wirecard lacked licenses. On paper, it sounded reasonable, but there was a problem. Very few people could verify any of it. The business structure was unbelievably complicated. Hundreds of subsidiaries, multiple countries, countless shell companies, layer after layer of paperwork. The complexity itself became protection. Because when something becomes difficult to understand, people often assume someone else has already checked it. Psychologists call this diffusion of responsibility. Everyone assumes someone else is doing the hard work. The banks trusted the auditors trusted company documents. Investors trusted analysts. Analysts trusted management, and management controlled the story. This is one of the oldest tricks in business. If everyone believes everyone else has verified something, nobody actually verifies it. Level 3. The journalists who refused to stay quiet. But not everyone was convinced. A small group of investigative journalists started asking uncomfortable questions. Among them was Dan McCrum of the Financial Times. He noticed strange accounting patterns, suspicious acquisitions, questionable contracts, inconsistent financial statements. Instead of answering the allegations, Wirecard attacked the critics. Executives called the reports fake. They accused journalists of manipulating the stock price. Lawyers threatened lawsuits. Regulators investigated. Not Wirecard, but the journalists. Think about that. The people exposing possible fraud were treated like criminals. This created an illusion. If regulators defended Wirecard, surely the company had to be legitimate. Right? Wrong. This highlights a powerful psychological bias. Authority bias. People assume that if governments, auditors, banks, and experts all support something, it must be true. History repeatedly proves otherwise. Sometimes institutions make the same mistakes as everyone else, because they're all relying on the same information. And if that information is false, the entire system becomes vulnerable. Wirecard continued growing. Its valuation exceeded 24 billion euros. The CEO became a billionaire. Investors celebrated. Critics looked isolated, until reality finally caught up. Level 4, the 1.9 billion euros that never existed. Everything changed with one simple question. Where is the cash? Wirecard claimed nearly 2 billion euros sat safely in bank accounts in the Philippines. Auditors wanted confirmation. Normally, banks simply verify balances. Easy, routine. Instead, the confirmations never came. Eventually, the Philippine banks made an astonishing announcement. The documents were fake. The money had never been there. Not delayed, not frozen, not misplaced. It simply did not exist. 1.9 billion euros. Gone. Almost overnight. Everything collapsed. Trading was halted. Executives resigned. Police investigations began. Investors panicked. The stock price crashed by more than 99%. One of Europe's biggest technology companies was suddenly worth almost nothing. Thousands lost their jobs. Retirement savings vanished. Banks lost billions. The CEO was arrested. Another executive disappeared. Jan Marsalek, Wirecard's chief operating officer, boarded a private jet and vanished. To this day, he remains one of the world's most wanted financial fugitives. Investigators believe he escaped through Belarus before eventually reaching Russia. His disappearance turned an accounting scandal into an international mystery involving intelligence agencies, fake passports, and global espionage allegations. The story became stranger than fiction. Level 5. Why smart people keep falling for corporate fraud. Wirecard wasn't unique. The pattern repeats throughout history. Enron, Parmalat, Luckin Coffee, Theranos. Each fraud looked different, but they shared the same ingredients. First, a compelling story. People love narratives. The future of energy, the future of healthcare, the future of payments. The bigger the vision, the less people question the details. Second, complexity. If investors can't understand how profits are generated, they often assume experts do. Complexity creates confidence. Ironically, it should create caution. Third, social proof. Everyone else was investing. Prestigious funds bought shares. Banks issued loans. Respected analysts recommended the stock. Nobody wanted to be the only skeptic. Finally, greed. When people believe they're witnessing the next Amazon, the fear of missing out becomes stronger than critical thinking. This is money psychology at its most dangerous. Markets don't just run on numbers. They run on belief. When belief becomes stronger than evidence, reality eventually wins. Always. That's why legendary investor Warren Buffett famously said that risk comes from not knowing what you're doing. Great investing isn't about finding exciting stories. It's about finding trustworthy businesses. Because financial statements can be manipulated. Marketing can be manipulated. Public perception can be manipulated. Cash flow, eventually, cannot. Conclusion. Wirecard wasn't merely a corporate scandal. It was a warning that billion-dollar valuations don't guarantee integrity, that prestigious auditors can fail, that regulators can be wrong, that media hype can overpower evidence, and that intelligence doesn't automatically protect anyone from deception. The biggest lesson isn't about Wirecard, it's about human nature. We naturally trust confidence, we admire success, we follow the crowd, we assume someone else has already checked the facts. But wealth isn't built by following excitement. It's built by asking better questions. Where does the money actually come from? Can the business model be explained simply? Do the numbers match reality? If not, walk away. Because in investing, avoiding one disastrous mistake can be worth more than finding 10 great opportunities. The next corporate giant could already be making headlines Its CEO could be giving inspiring interviews. Its stock could be breaking records. Everyone could be calling it the future. But remember Wirecard. Sometimes the companies that look the strongest are standing on the weakest foundations. And when the truth finally arrives, it doesn't knock. It crashes through the front door. If history teaches us anything, it's this. In business, trust is valuable, but verification is priceless.